excited to be here on this beautiful spring day. We've got the sunshine pouring in our windows, and the title of today's episode is Don't Miss the Moment. Don't miss the moment. I love that title. Jeremiah, what moment are we not wanting to miss?
Yeah, this is an exciting moment for a lot of people. They were about to sell their business. We're going to walk through a hypothetical. You've been working, you've been growing, you're about to sell your business, but it's a moment. You have a tax moment, you have an investment moment, you have an opportunity to really build where you're headed. The whole reason that we do this type of stuff is not just you need someone to babysit your money. It's not just to get you through a transaction. It's to say, what are you building in life? What is a person who's listening to this? Where are they headed? And one piece for many of our clients, for many people that we know, and things that we talk about, is they have a business, and at some point in the future, they might sell it. Well, that's a moment. It's a moment to really set you up on a path towards some of these goals that you have, unlike other moments.
Another way to look at it is avoiding some landmines if there's some preparation ahead of time. So we're going to talk through 4 or 5 different techniques, things to consider in advance of a moment. We're going to talk of examples of business owners, but this might apply to others where you've got a year with exceptionally high earned income. So your tax liability is going to be exceptional. Here are some things to think about. Jeremiah, why don't you get us started with real estate?
Yeah. So imagine, as an example, someone is about to sell their business. They're excited. We're just going to put a price tag of 25 million. It's just great. They're excited about it, but they also now say in the back of their mind, what about taxes? Ooh, I'm going to pay a lot of taxes, right? And we've always talked about real estate. We've always talked about passive income. I'm not sure what to do. So real estate has a couple of key things. The first one we're going to talk about is called opportunity zones. The program existed for years. It ended in 2026. A brand new opportunity zones program starts in 2027 and goes forward. So opportunity zones in general is to say there's parts of the country where there's not as much investment coming in. So the government has designated them as opportunity zones and have said if you take money, if you put it into these opportunity zones projects, whether it's building apartment complexes, building warehouses, a number of other type of things, if you're going to put money in here, we'll allow you to defer some of the capital gains that money had when it came over, as well as give you some step up in basis. So you get to potentially delay your taxes and maybe even avoid some of the taxes. In the event that you take some of the money from, say, the sale of a business, and you, within 180 days of the sale, you put it into an opportunity zone. There are lots of rules here. There's lots of details. And even what I just said about 180 days, man, you got to get an advisor in there with you who understands each of those markers of how to properly get this money into an opportunity zone.
Yeah. And one thing I would note on the opportunity zones is it doesn't have to be done alone. You could be the single investor in something like an opportunity zone, but there's also things called opportunity zone funds, right? Where you can group together different investors. Those have a little bit more complexity, but I just want to lob that idea out there as well. Let's talk another topic regarding real estate and tax savings and cost segregation.
Yeah. So if opportunity zones don't light your fire, it's not what you want to be about. And then part of the whole reason for real estate, I'll back up one step, is a lot of people enjoy real estate because it's a different asset. It's not the stock market. It's not their business. It's a different asset class. A lot of these types of structures, they just pay rents. And especially as Laura said, if you're in a larger investment group, you're not managing yourself. You're not checking on pipes in the roof and things like that. You're just an investor, but you're getting regular income over time related to investments. Another part of real estate is at times, depending on the structure, you can actually get reductions in your taxes through depreciation. And so cost segregation, Laura, as you teed up, is the other one to talk about, to say if as part of this moment in your transaction, you say, we've always wanted to own a warehouse. We've always wanted to own a commercial building, and that fits with our long-term planning. What if we buy one this year, the same year as the sale, and we do what's called a cost segregation study on it so we can accelerate some of our depreciation? Those are some big words I just said, right? But to kind of dive into it a little bit, you think of, say, a warehouse. Probably there's a small office space. There's probably some loading docks. There's probably some lighting. There's probably a number of things that go into that warehouse. Well, under current kind of depreciation rules, your accountant would walk you through that and say, okay, you can take roughly 39 years and depreciate this whole building. In a cost segregation study, they kind of get a little more fine-tuned on that and say, well, the walls and the roof, you can depreciate that over roughly 39 years. But these light fixtures, you can depreciate those maybe over 3 years. And these office spaces that are built out, you can depreciate those maybe over 10 years. And so there's different rules of how long each of the parts of the depreciation can be taken. And what that does, when you segregate each part out, you can accelerate and take more quickly some of that depreciation. It reduces some of those taxes, but also leaves you with less long-term depreciation. So whether it makes sense for you is a great question.
Yeah.
But someone who is in a year where they have a much higher income, it's a great discussion. Someone I'm sure will come up in the comments of saying, "Hey, there's passive income versus active income." Yes, that's a great comment, right? That needs to be considered and dealt with. There's something called real estate professional status that can help bridge that gap if it's
Yeah.
appropriate. So there's a number of things there, but the key part I think we want to take away, even today as we talk about it, is you're in a moment. You're in a calendar
Yeah.
year when you sell your business. That if any of these other items make sense for you, they have to get done in that year to be helpful.
Love that. You touched on some really great topics there, and there's more to that. I think you're also accurate in that just the complexity that's there. You need your CPA and an advisor to come alongside you. Will these actually benefit you in the moment that you're in? Because it really depends. One of the ones I'm so excited to talk about, just to bounce off of real estate for a minute, is charitable giving. And so many of our listeners might have heard of something called like a bunched giving strategy, or we've commonly heard of charitable foundations. This benefit, tax benefit, would apply to our listener who is accustomed to charitable giving on a regular basis. If you typically give to a 501c3 or a 501c6, et cetera, this option might particularly be a benefit to you. And I like to call it, it's very similar to a bunched giving strategy, but we talk a lot about opening a donor advised fund. On the platform that we work in, there's not a minimum funding requirement. This is also a strategy that can come into play later in the year once you're getting kind of some final assessment of what your tax liability might be in the year. But the difference between a bunched giving strategy and a donor advised fund is you accelerate the giving amount into 1 year and you make an irrevocable contribution into this donor advised fund. These funds are intended for charitable purposes. The irrevocable term means that they can't come back into your estate. So you're making a permanent decision to transfer funds or appreciated stock into a donor advised fund. It's in that moment that you receive the tax benefit or the tax write off. However, unique to a donor advised fund, it doesn't mean you have to give it that same year. So we have many clients who have a year of higher than anticipated income, or if it is anticipated, they know it's a one off year of higher income. And so they plan to kind of group their giving. Let's say, for example, they give $100,000 a year. So if they give $100,000 a year and they know that this year they're going to have an exceptionally high earned income amount, they may go ahead and contribute 200, 300, 400,000 into their donor advised fund, of which it can be invested. They'll receive the tax write off for the completed contribution to the donor advised fund. But over the next several years, they can continue to give from their donor advised fund. The other piece that I love so much about the donor advised fund is it is a legacy piece. Again, those funds are marked irrevocably for charitable purposes. So if the account owner were to be deceased, the beneficiaries then would continue that legacy of giving. It doesn't necessarily denote to whom the gifts need to be given, but that they are marked for charitable purposes. So I love that of the donor advised fund too.
So valuable. And you explained that really well. I think even just taking a pause, we've talked about two really big items, right? Donor advised funds, real estate investing. And as we said at the beginning, like this isn't for everybody, right? These are things that, snares we see, but it's a good reminder, say, don't miss a moment to consider these things. And I love the way you said that, Laura. Some people are exceedingly generous in other ways to family and whatnot. Others are saying, no, I regularly give to churches, to charities for things like that. And I'd like to do more of
Yes.
that in the future. And so I think it's so powerful to say in these moments, something to consider. All right. So we've talked about, in this scenario, someone's going to sell their business. We've talked about giving to a donor advised fund if that builds the future you're excited about. We've talked about moving into some real estate and to say, wow, there's some powerful opportunities there if that's part of what you want to build. The next two, I think these are both good. They're kind of on the far ends of when to think about these. So I'll start at the very early one. We're going to jump to QSBS. What is that? Most
Ooh,
people
tell
have
me.
not
I
heard
love
this.
a good acronym.
Yeah, that's right. And we were at, level one initially, then we're at level two. This is probably like a level five of like what people have not heard of. So QSBS is a qualified small business stock. And so there's lots of rules around this as well. But if you are a C Corp, that's important. Taxed as a C Corp before the IRS, and you have an original issuance of shares, meaning that you like founded the company, you started it, you set this up, you can get what's called QSBS status for your shares. Wonderful. You operate your company just as you would. When you go to sell the business, if you have QSBS stock, you can get a $10 million capital gain exclusion. I said
What? Say
again,
that again.
a,
How much was
a
that?
$10 million a capital gain
Drum
exclusion for
roll,
selling the
please.
stock. And there's something else that's called QSBS stacking, meaning that you can have multiple owners or multiple trusts that each make a QSBS election. Again, lots of hoops, lots of things. Anybody thinking about this, you need to work with an advisor who knows what they're doing. There's actually specialists in this field of QSBS stacking. People who
And
have
not
been
a last minute strategy, which I think is fairly obvious by the complexity that you're talking about. Yeah.
and these, I think there's, I don't even know the specific. I think it's like a 5 to 10 year holding period that you have to in business. A lot of businesses that are profitable eventually become S corps, which could be good for other reasons, but it doesn't work with this QSBS concept. So something to consider, something to talk about. This is very early on, even back to when you're founding
Hmm.
the company. If it's something you're going to build and sell.
Yep.
So now we can fast forward all the way to the deal.
Okay, so I'm going to take up the next one, which is how you structure the payout of the deal. So typically, in the examples that we're talking about, there would have been a valuation of the company, either your position, your equity position in the company. And so, as you're walking through the deal documents, it does not have to be structured in such a way that your entire payout comes all at once. And one of the benefits of being able to structure what's called an installment note is to pace out your tax liability as you get paid out from your equity position in a company. One of the things and factors to take into consideration regarding an installment note is that there will probably be a negotiated interest rate on that installment note. And for you, if you are the one being paid out, you could structure the deal in such a way that you might be paid out over several years. So while you'll face added tax liability in those years while you're being paid out, you can at least start to space it out over 3, 5, 10 years. What's reasonable, right? Or more. So this is something that's commonly used. This can be used in different types of entities and structures. And this would be something that you would definitely need to put into the deal docs as you're negotiating the payout over time. So installment notes help by just spacing out the payment that you'll receive from the deal.
And for some folks, that's not even on the table, right? They just say, I need to get paid out. That's not the way the transition works. But for some deals, it's a really helpful piece to say, let's spread out some of this income. I don't need it
Mhm.
all right now. And in fact, I could delay some of these taxes. And some people would say, well, it's all capital gains anyways. Well, potentially California, where we're at, does not have capital gains for the state tax. They just tax it as state tax. Federally, although you'd be getting capital gains treatment, state, you're going to get all sorts of different tax pictures. And so what we always encourage in this type of scenario is to consider, what is my after tax situation, not just maximizing the valuation and the purchase price, which is the first step, I would
Mhm.
say. But the other step is say, what are we doing that is going to really tune up our taxes so that we're getting the best after tax outcome? And the third layer, that what we're talking about today, is what else are you building? Are you building
Yeah.
a donor advised fund that really, really care about, or is that something that's off the table? Are you building a robust real estate portfolio that's going to serve you into the future?
Because maybe after your exit, you want more passive income than you do earned income. This is where you have an opportunity because you have enough capital to do so, right?
Yeah. One of my favorites is the little wheel pie chart that people look at and say, well, how much should I have in real estate? How much should I have in short term investments? How much should I have in bonds and equities? And there's a little bit of difference for everybody, but generally our approach is it's a both and. We're not looking to put all our eggs in one basket. We're looking, especially when you have an exit from a business, even if you had a lot of your eggs in that one basket of your business, now that you exit, man, we want to diversify, not just between stocks or bonds, but across different asset classes, qualified, unqualified, charitable, not charitable. We want all that spread out.
A healthy portfolio is a well diversified portfolio. We talk about that a lot. And this is that moment in time where we're talking about your concentrated position in a business has created wealth for you in these examples that we've been talking about. But in order to move that into a well diversified portfolio, we'll preserve that wealth over time. I'm excited to kind of tee up the last piece of the puzzle that we're going to talk about today, which goes hand in hand with what you're talking about, which is, what are you building over the long term? There's some conversations upcoming on the podcast with people who actually come alongside you in this moment of transition, right? There's so many things happening. Maybe your purpose on a day to day basis or showing up to the office may look completely different. So sometimes it takes a moment to retool, and we get to do some of that work alongside of our clients. And I tell you, those who have a more clear picture of where they're headed and what they'd like to accomplish in the next season of life That clarity is so beneficial, and they're going to maximize the value of that going forward. And so the last piece of the puzzle that we're going to talk about is kind of family legacy trust structures. Again, there's a lot here, and I'm going to have the resident attorney talk about this because he's the expert on the topics.
Yeah. And we're not going to dive too deep just for time. We're not going to dive too deep into the different types of trust and what you might set up, but just starting that conversation and, scenarios that we see of, if you have this type of exit, a $25 million exit in this example, you've thought about donor advised funds, you've thought about real estate, you've thought about installment notes, you've thought about QSBS, you've done all that stuff. And now you have your exit. Very likely, this money is not money that you're going to spend through in your lifetime. It becomes money that is going to flow to the next generation. And so the question becomes, just as Laura, you said, the first job of all this money is to care for you. What are you going to do? What are you going to spend your time doing? How are you going to utilize these resources during your lifetime? And then right behind that comes the question, well, what's next? Is this money for my family? Is this money for my kids? There's defaults that we see. People say, well, I'll just give it to my kids. They're doing great. Wonderful. That might be the end of the story. Often, though, with this type of wealth, we're now considering what safeguards do your kids need? Well, what about your grandkids? There's even a conversation we've had with a number of clients of an idea of a family bank, of saying a certain amount of money gets set aside in a trust type structure. It's got a board around it, and cousins, nieces, nephews, people can come to the family bank and make a proposal. Hey, I want to start a business and I need $300,000. I would like to come to the family, and there's a structure in place for them to make a presentation, the family, the key people at that moment to vote on it and to either fund or not fund that type of adventure. Man, think of that you've built, that could now move on to generations beyond you and have what used to be your kids now helping run a family bank that's benefiting the rest of your family. There's really powerful thoughts of not just what your money can do for you, but what it does for multiple generations. One thing in the law is this idea of dynasty trusts. Some states like them, some states don't. The idea is that it's a trust that will last for maybe 200 years, 300 years, a long, long time into the future. California's laws are kind of anti that. They want the money to get to the next generation make good choices with it. Other states, however, allow you to lock up money and put rules on it well into the future. And so if that's something that you want to structure for your family's future, there's a lot of conversation to have in there and a lot of flexibility. Again, not something you walk through alone. You need a seasoned estate planner, probably a financial advisor as well, to walk through what this would look like. But there's some real powerful thoughts of how to not just, by default, give it to the next generation, but really set them up on a whole level that you potentially never experienced. Thoughts and opportunities that you didn't have, now they can have in a safe way. There's an unfortunate statistic that, first generation, will grow a business, second generation will maintain it, and third generation will lose it, whether they sell it or if it just crumbles. And so multi-generational businesses are very difficult. Same with multi-generational wealth. Whoever's the founder, the builder, that's often the people we're working with, those situations, you have some opportunity to say, what's going to not just help my family, but really serve them to thrive and be productive. So it's a conversation I love to have. I think it's really useful just to have those thoughts of saying, this is more resource than one generation likely needs. How do we use it for the future?
Yeah, they're meaningful conversations. It's the work that we love to do. So, just to kind of wrap up our time, if you are preparing for, or if you know of someone who's preparing for a season of high income, and they're expecting a lot of sort of tax maneuvering or a tremendous tax bill. In fact, they don't even know how much they're going to have to pay, right? So we don't want them to miss the moment. There are some tactics that can be put into place to build the life that they are aspiring to have over the long term. And you don't want to do this alone. There's a lot of complexity. Every day we get examples that we can use here on the podcast. But if you, our listener, has any questions or topics that you'd love for us to talk about, please reach out to our office. We would be happy. You can go tricordatadvisors.com and give us some topics to talk about. We'd love to share them here. To all of our listeners, thanks so much for listening. We have a few more things to let you know about before we go. Podcast reviews really help us to serve more people and get this information into the hands of the people who need it. Please leave us a review. Even if it's not 5 stars, we welcome the feedback.
And we invite you to let us know what topics you would like to hear more about, or what would benefit the people in your life who you're closest to. We have more resources online. Those resources are designed to help you share this great information easily with people in your life. To access those resources, please visit tricordatadvisors.com.
Often we hear from clients that they wish they had talked to us sooner. If that's you, We'd be thrilled to see how financial planning can benefit your life. Email us at contact@trichordadvisors.com or simply click on the link in the show note.
We love creating content that's useful, resourceful, and maybe even a little entertaining. We want to make this mega universe of financial topics and advice applicable and helpful to your life.
Remember, at Trichord Advisors, we are your future's best ally.